We open with a simple but essential truth. Gold and Bitcoin are not just different assets, they operate on different mathematical engines. Gold behaves like a slow-growing inventory of a physical commodity. Its supply expands inch by inch as miners extract new ounces from the earth and old jewelry gets recycled back into circulation. Think of it like a river that flows steadily year after year, sometimes faster, sometimes slower, but rarely surprising anyone. Bitcoin, on the other hand, is built on a digital protocol that manufactures shockwaves on purpose. Every 4 years, the network triggers a halving, a programmed event that cuts new issuance in half. Imagine a faucet that suddenly goes from full flow to a narrow drip overnight, while demand stays the same or even increase. That kind of structural jolt doesn't just reduce supply, it rewires the entire supply-demand equilibrium. Once you understand this split, a deeper question naturally follows. How does this mathematical difference actually show up in the real world? In gold markets, price movements unfold slowly. Because supply grows gradually, major rallies often require years of steady demand, central bank buying, inflation fears, or long-term shifts in global savings preferences. It's compounding through patience. Bitcoin's market reaction is the opposite, cyclical, abrupt, and reflexive. Halvings create scarcity shocks, liquidity amplifies the move, and narratives accelerate it even further. The result is a pattern of sharp drawdowns followed by explosive asymmetric upside. But once you understand this structural split, a deeper question emerges. How does this play out in real markets? As we zoom in on the mechanics, we begin to see that gold supply follows a slow, almost breathing rhythm, expanding gently, contracting gently, but rarely jolting the system. Gold behaves like an industry, governed by physics, geology, and time. Mines don't suddenly double output because prices spike. They respond the way a cargo ship turns, gradually, with inertia. Mine production rises or falls based on 3 things: available capital, the difficulty of new deposits, and whether the price justifies deeper digging. Recycling adds another small layer, like an auxiliary stream feeding into the main river. And in 2024, the numbers told the story clearly. Global gold supply increased by only about 1% year over year, driven by record mine output and a modest bump in recycled gold. That tiny expansion is the entire point. Gold's supply curve doesn't bend for headlines, hype cycles, or social sentiment. It bends for decades of cumulative economic behavior, long-term central bank buying, generational wealth storage, and cultural demand. Gold moves with the patience of an asset that has been relevant for thousands of years. And right as this slow dance unfolds in the physical world, Bitcoin performs something far more dramatic. Every 4 years, Bitcoin experiences a structural reset, an event baked directly into its code known as the halving. If gold's supply behaves like a slow-moving river, Bitcoin's issuance behaves more like a faucet that suddenly tightens itself without warning. Except this isn't random. It's predictable, scheduled, and publicly known years in advance. A halving simply cuts the number of new Bitcoins entering circulation by 50%. To make this relatable, imagine a farm that produces 100 apples a day. Overnight, without changing land, labor, or demand, that farm is forced to produce only 50 apples. Same buyers, half the output. Naturally, scarcity intensifies. Halvings in 2012, 2016, 2020, and most recently April 20, 2024 all followed this exact pattern. New supply was slashed, miners earned fewer coins, and the market entered a completely different pricing environment. These weren't soft nudges, they were supply earthquakes. And history shows the market didn't just respond, it reacted aggressively. Each halving preceded some of the most dramatic bull cycles Bitcoin has ever seen. It wasn't magic, nor hype alone. It was the math, fewer new coins meeting growing global demand. This is where Bitcoin's deterministic issuance stands apart from physical commodities. Gold miners can ramp up output when prices surge. Oil producers can drill more wells. But Bitcoin's supply cannot be increased on demand, no matter how much capital wants in. And this structural divergence leads us directly into the next contrast, their observed return profiles. Gold has a long history of steady, reliable returns. According to Visual Capitalist, from 2000 to 2025, gold delivered annualized gains of roughly 11%. But here's the nuance. These gains are like running a marathon, not sprinting a 100-meter dash. Gold doesn't surge overnight. It grows slowly through long arcs of demand, cultural trust, and macroeconomic pressures. Think of it as a river carving a canyon, gradual, patient, unstoppable. You don't invest in gold expecting a 10x windfall in a single quarter. You invest for stability, continuity, and protection against the erosion of purchasing power. Bitcoin, by contrast, writes a completely different story. Its returns are concentrated in episodic parabolas, periods of explosive growth that compress what would take years for gold into mere months. Imagine a rocket rather than a river, rapid, vertical, and fueled by both scarcity and adoption momentum. This extreme skew isn't a bug or market inefficiency. It's a feature built into Bitcoin's design. Supply is algorithmically capped and halved at predictable intervals just as adoption surges, creating rare but outsized opportunities. With return profiles diverging so sharply, the next question is inevitable. What does this mean for risk? The volatility and drawdown patterns of gold and Bitcoin are fundamentally different. Gold moves slowly, like a large ship navigating calm seas. Its price rarely swings violently within a single year. When gold does decline, the drawdowns are long and extended. For example, after the 1980 peak, gold entered a multi-decade lull. These slow adjustments reflect the patient, physical nature of supply and demand. Bitcoin, in contrast, is highly reactive. It can lose 50 to 90% of its value within months, only to reverse and climb 10x in the following cycle. This is not random volatility, it's structural. The difference lies in market mechanics. Gold's deep liquid markets cushion against sudden shocks. Bitcoin's liquidity is concentrated, narratives dominate, and halving events amplify scarcity. These forces combine to create extreme price swings. Think of Bitcoin as a digital rocket. One moment it hovers, the next it accelerates, fueled by adoption, speculation, and programmed supply constraints. Each halving acts like a fuel injection, pushing prices higher while reducing new supply. Risk management must reflect these contrasts. Gold suits investors seeking stability and slow compounding. Bitcoin suits those seeking asymmetric upside but able to tolerate severe drawdowns and high emotional swings. And speaking of liquidity, this brings us to another critical separation. Gold isn't just a shiny metal. It lives in a deep, global market that stretches across decades, with trading in physical, over-the-counter contracts, futures, and ETFs. Its ecosystem is massive and resilient. Large gold trades barely make a ripple. Imagine trying to move an ocean with a bucket. That's how the market handles big flows. Price shifts are gradual, often unfolding over months or even years. Bitcoin, in contrast, is still finding its legs. Its liquidity has expanded tremendously, especially after the 2024 U.S. spot ETF approvals, but it remains far more reactive to significant buying or selling. Think of Bitcoin as a fast-flowing river. Drop a boulder in and the currents react instantly. A single large order or redemption can spike volatility in ways gold never experiences. For investors, this matters. Gold offers stability, patience, and the comfort of a centuries-old market. Bitcoin offers opportunity, speed, and dramatic swings, where timing and positioning can make all the difference. Understanding liquidity is crucial. In gold, depth protects you. In Bitcoin, depth exists but is thinner, meaning your trades have more influence on price, a subtle but powerful factor for strategy. Yet that ETF approval moment didn't just increase liquidity, it rewired Bitcoin's entire reflexive structure. Bitcoin acts as a narrative amplifier. Its price doesn't just move, it reacts to stories, adoption, and regulatory clarity in real time. When on-chain adoption jumps, ETFs flow in, or regulators clarify policy, price acceleration follows quickly, often catching traditional markets off guard. Media coverage amplifies the cycle. Each headline draws more investors, fueling momentum. Network effects compound rapidly, creating feedback loops unseen in traditional assets. Gold, by contrast, tells a slow-burning story. Its narrative is steady, rooted in centuries of cultural, monetary, and industrial relevance. Central bank buying, jewelry demand, and historical significance shape gold's value. Movements are deliberate, structural, and largely unaffected by viral narratives. Bitcoin's speed and sensitivity creates opportunities and risks. Traders must monitor adoption metrics, policy shifts, and liquidity flows to anticipate regime flips. Investor psychology plays a key role. Fear and greed amplify Bitcoin cycles, whereas gold's market is calmer, more predictable, and less reactive. ETFs, institutional inflows, and regulatory clarity act as catalysts. Each triggers adoption and price movement in ways that are highly nonlinear. Gold stability provides context. It anchors portfolios during volatility. Bitcoin, however, can both amplify gains and intensify drawdowns in short periods. Understanding Bitcoin requires tracking signals across multiple layers: on-chain, institutional, and macro. Its narrative-driven behavior defines its unique market dynamics. The lesson: Bitcoin is living market storytelling. Its cycles are written by adoption, policy, and perception, while gold quietly persists, slowly accumulating value over centuries. This distinction becomes even clearer when we examine the empirical evidence of recent cycles. Following the 2024 halving and ETF approvals, Bitcoin entered a high-velocity growth phase, surging through late 2024 into 2025. Institutional flows amplified price momentum. ETFs funneled capital into the network, while on-chain adoption and media narratives reinforced bullish sentiment. By November 2025, the cycle shifted. Large ETF redemptions triggered a sharp correction, catching many investors by surprise. Some outlets reported drops exceeding 20%. Bitcoin's flow sensitivity proved consequential. Liquidity events, regulatory updates, and institutional behavior continue to dictate short-term price regimes more than fundamentals alone. Volatility, however, does not equate to weakness. Bitcoin's rapid swings reflect evolving market infrastructure, capital concentration, and adoption dynamics. Meanwhile, gold moved steadily through 2025. Central bank buying and tightening supply drove a consistent, slow compounding upward trend. Gold's macro behavior contrasts Bitcoin. Its strength is structural, measured, and resilient, less reactive to narrative cycles or short-term liquidity shocks. Investors observing both assets see a pattern. Bitcoin amplifies flows and sentiment, while gold quietly compounds value through fundamental scarcity and demand. The interplay of fast-moving crypto and steady gold illustrates different market mechanics. One narrative-driven and flow-sensitive, the other slow, structural, and enduring. Gold offers perspective. Bitcoin delivers velocity. Together, they reveal the spectrum of asset behavior, from rapid amplification to disciplined, long-term compounding. And this brings us into an equally important dimension: regulatory and policy risk. Bitcoin is exposed to asymmetric regulatory shocks. Sudden clampdowns on exchanges, ETFs, or custody can trigger rapid outflows within days. The speed of these shocks makes Bitcoin uniquely reflexive. Liquidity dries up instantly, prices adjust sharply, and market participants scramble to reposition. Gold, by contrast, rarely experiences risk at this timescale. Its markets are slower, more structural, and buffered against abrupt shocks. Regulatory events create a dual-edged environment. Bitcoin's volatility is amplified during clampdowns, but also rewarded during policy clarity or adoption news. Conversely, coordinated central bank purchases or fiscal stress can push gold higher. Its response is deliberate, reflecting fundamental supply-demand dynamics over months. Bitcoin surges are reflexive, narrative-driven, and often nonlinear. One regulatory announcement can amplify flows, media coverage, and investor behavior almost simultaneously. Gold's ascents are steady, compounding over time. Central banks accumulate reserves, supply tightens, and the price gradually reflects structural scarcity. Investors must differentiate between shock-driven volatility and long-term value. Bitcoin reacts in hours or days. Gold moves predictably over months or years. Understanding market mechanics requires monitoring both. Bitcoin offers high-velocity opportunities, sensitive to liquidity and policy shocks. Gold provides structural stability and slower, reliable compounding. These asymmetric dynamics define portfolio strategy. Short-term agility is critical for crypto, while long-term patience and macro insight govern gold's behavior. Understanding these contrasts leads us into the microstructure, the invisible machinery of both assets. Bitcoin's microstructure is fundamentally on-chain and highly dynamic. Every transaction, reserve shift, or custody event can influence market perception almost instantly. Network congestion can distort liquidity signals. Delays in settlements or mempool backlogs may trigger temporary volatility, amplifying sentiment-driven price movements. Exchange reserve movements are critical. Large inflows or withdrawals from exchanges often act as precursors to sharp price shifts or liquidity squeezes. Custody events, from institutional wallets to liquidations, ripple across the network. Bitcoin's price responds reflexively, reflecting the immediate state of available supply. Gold operates differently. Its price discovery occurs primarily in large, slow-moving OTC markets and structured futures curves, which absorb shocks and limit panic-induced swings. Retail-driven panic is muted in gold markets. The scale and opacity of institutional trades prevent the same rapid feedback loops seen in crypto. Bitcoin's on-chain transparency is both an advantage and a vulnerability. Traders can track flows in real time, but emotional reactions can amplify volatility. Understanding microstructure requires monitoring multiple layers: exchange reserves, custody events, network congestion, and on-chain liquidity metrics, not just macro fundamentals. Gold's steadiness contrasts Bitcoin's reflexivity. Its slower feedback loops produce smoother price paths, emphasizing structural factors over instantaneous sentiment. Investors should recognize these differences. Bitcoin offers speed, visibility, and reflexive opportunities. Gold provides stability, dampened emotion, and measured structural discovery. And finally, after all these mechanics, we land at the part most investors ignore: the role you play and the time horizon you choose. If stability, predictability, and purchasing power protection matter most, gold remains unmatched. It delivers minimal ruin risk even in turbulent macro environments. Gold's value is structural. Central bank reserves, industrial demand, and cultural significance compound slowly, providing reliable defense against inflation and systemic shocks. Bitcoin offers a different proposition: asymmetric upside. Its volatility is high, but the reward potential is amplified through protocol-driven adoption and network effects. Severe drawdowns are part of the equation. Investors must tolerate short-term losses to capture long-term, high-risk adjusted returns in crypto markets. Allocation matters. Bitcoin cannot be deployed blindly. Position size and risk management dictate whether volatility becomes opportunity or catastrophic exposure. Understanding adoption cycles is crucial. Protocol upgrades, ETF flows, custody infrastructure, and regulatory clarity all influence Bitcoin's reflexive price dynamics. Gold and Bitcoin occupy complementary roles. One provides stability and slow compounding, the other offers growth potential, narrative amplification, and high-velocity market behavior. Psychology is a factor. Optimism alone cannot justify exposure. Discipline, context, and timing are critical for managing asymmetric assets effectively. Risk-adjusted strategy demands nuance. Bitcoin's high beta requires active monitoring of liquidity, institutional flows, and macro conditions, while gold remains largely insulated. Investors must design portfolios intentionally. Stability, upside, drawdown tolerance, and temporal perspective define the balance between safe haven and high volatility allocations. Which brings us to the final synthesis. Gold crawls, Bitcoin leaps is more than a catchy line. It captures the fundamental difference between two distinct economic engines. Gold moves through slow, steady, supply-driven compounding. Its strength comes from structural scarcity, central bank reserves, and predictable demand. Bitcoin grows through episodic, reflexive, protocol-driven multiplicative cycles. Price responds rapidly to adoption, ETF flows, and on-chain liquidity events. These are not competing assets. They are complementary architectures of value, each optimized for different temporal and risk dynamics. 2024 and 2025 highlighted these distinctions. Bitcoin surged after the halving, fueled by ETF inflows and rising institutional adoption. Gold, in contrast, continued its measured ascent. Central bank buying and tightening supply drove a slow, compounding, structurally resilient rally. Bitcoin's velocity is amplified by network effects, narratives, and liquidity reflexivity. Movements are non-linear and often amplified by market psychology. Gold's power lies in predictability. It mitigates ruin risk, anchors portfolios, and compounds purchasing power steadily over time. Both assets coexist in the same financial universe. Investors can harness Bitcoin for asymmetric upside and gold for structural stability. Understanding these architectures requires context. Timing, allocation, and macro awareness define whether capital exploits Bitcoin's leaps or gold's slow compounding. Both assets belong in a modern portfolio, but each demands its own rules, its own respect, and its own understanding. If this video resonates with you, click on the card above. I've got more insightful videos. This is Blockchain Money.